Welcome to this panel. So this will be the panel about risk-free yields, a very broad topic. I'm Matthias from ChainSecurity, CTO at ChainSecurity. And to get started, just a quick introduction round from everyone on this panel, to see how each one basically contributes to helping going from this former very wild west times of yields to this more stable, risk-free yield discussion we'll have today.
Hi, everybody. I'm Stefan Rust. Been in Bitcoin since 2012, but we launched MaxCap, which is a protocol that allows people, two-token protocol, which allows people to have a yield-bearing stablecoin, and then allows the stewards of the protocol to actually participate and ensure yield and provide that. I'll talk to him more about it later.
Hi, I'm Yaro. I'm building Molecula. That's my kind of latest project. I've been doing DeFi and crypto since 2017. Essentially, Molecula is the way we see we should onboard the idle crypto capital, like the stable coins and ETH, which is sitting passively on the wallets. And we do it by creating the money market fund-like infrastructure that allows people to just deposit their crypto and sleep peacefully.
Hi, I'm Gaspard. I'm one of the co-founders of Spectra, previously called IPOR. We do interest rate derivatives in DeFi. That provide tools for you to speculate on the yield variations, but also to provide a fixed income instrument.
Yeah, hi, I'm Darren Camas, co-founder of IPOR Labs. We build two products. One is the IPOR protocol, which was literally founded around defining what's the risk-free rate on chain and creating a peer-to-pool interest rate swap around that. And the other one is Fusion for automated asset management in DeFi.
Hi, I'm Alan, founder of Covenant. We provide low cost of funding for asset issuers and protected yield for depositors, so basically stablecoin banking. And we do this through a perpetual permissionless tranching mechanism of Onchain.
Thanks, everyone. So just to get quickly a little bit more into depth for this, so in this world where we have more and more complexity, right? Is it important to go and simplify it? A question for Yaroslav.
Oh, thank you. That's the key question for me, because I think the main problem in DeFi right now is not the tech, but kind of the broken UX and broken communication. And even saying risk-free yield, probably for me it sounds wrong. It's like a shady promise. So yeah, I think we need to kind of simplify everything from interfaces to the way we explain how things work, because I would say 9 out of 10 DeFi protocols, a normal person wouldn't be able to understand what's in there. Even the words are different and unknown. So I guess that's the ultimate goal right now for the entire industry, to kind of understand that if we really want to bring, not even talking about bringing new money to crypto, but even making the money which is already in crypto, which is already on these are hundreds of billions of dollars sitting on the wallets of people because they don't understand how to start doing anything with that. So yeah, I guess that's the ultimate task for the entire industry.
Short follow-up question to Darren on this, what's the role of the public benchmark in there to basically enable a lot of this?
Yeah, I mean, if we look at the term risk-free in traditional finance, you can typically consider it as the treasury rate, or between financial institutions, something like an interbank offered rate, like the LIBOR, or something like the SOFR, right? So there is already contextualization about what does risk-free mean, and it's typically around different solvency calculations, and this is what the risk-free rate is in traditional finance. And you actually use that as your kind of benchmark rate to structure different debt derivatives and deals around it. So actually, we look at that idea of basically what is the risk-free rate in finance in TradFi and bring it to DeFi. But in DeFi, we have a very nice construct, which is people borrow in DeFi. They borrow against a high-quality collateral asset, and that information, that rate information is printed on chain, is printed out the rate modules in Aave and Compound and Morpho and Euler and Fluid. So actually, you have a very nice public benchmark. It's smart contract-based, and it's on chain. So we take that and we say this is the best proxy to risk-free that we have in DeFi. Risk-free, though, there's a bunch of nuances around that. Like risk is always tied to, well, I mean, risk in one sense is tied to obviously the smart contract risk, but it's also very much tied to the collateral that you have, the ability to liquidate the collateral. But all of this nuance is really around like, can the lender be made whole? And in DeFi, we have this beautiful construct. So we take that, we created a benchmark, and we allow you to trade it peer to pool. So that creates this interest rate swap market, which is kind of your base of the fixed income ecosystem. I mean, Spectra also does it does a derivative on kind of a different type of yield. But the whole idea is, what's risk-free? How do we create this risk-free benchmark? How do we build this yield curve in DeFi? And how do we basically, replicate what we have in TradFi, but having something more transparent, more automatable that we have in DeFi?
And perhaps next thing to Stefan, we have that index, but why is it like for sustainable returns? Why is it important that you tie it to real-world data?
Yeah, so, I mean, I like sort of a lot of the analogies. And what do we do? I mean, we've launched a token. Two things. How many of you have actually seen Billions, the TV show? Billions? I guess yeah? No? Nope. Okay, over there, 5 people. Do you guys like it? There's a character in there called Axelrod, right? Axelrod, he runs Axe Cap or Axe Capital. And basically, he's a GP of managing funds. And what do GPs do? They're general partners. They are the fund managers that assign and define risk, reward, return. There's no risk-free yield. I mean, that doesn't exist anymore, right? So how do they achieve a yield? And they have to hit a hurdle rate. And anything above that hurdle rate, they earn money and they take that money, a percentage of that money from their investors, the people that give them money. And so what we're trying to do is replicate that model and allow anybody to be an Axelrod, because there are so many smart people in the room. Look at, I mean, we work very closely with IPOR, like Darren. I mean, he knows, where do I get the best yield? Those are people that aren't, sort of Harvard educated, have gone through the right schooling, have been through banks, but they are on-chain. They know the on-chain transparency. They're literate around all of that. How do they become the fund managers of the future? How do they participate in a stablecoin that has a hurdle rate as true inflation? The true inflation beats inflation and then ultimately shares additional reward with themselves, who are generating the yield in excess of truflation, and at the same time providing that excess yield to the participants that are the LPs in the fund. The LPs are the people that are giving the money to the GPs. And so that's what we're trying to build, all on-chain, self-custody, fully transparent, so that anybody can see, where you wouldn't see anywhere else, what that opportunity would look like and what that yield would bear and what the underlying security looks like.
Stefan, would you argue that the hurdle rate is the risk-free rate, or how do you set it?
Yeah.
Yeah, we kind of go up and up the stack of complexity, and this is where we come both to like Spectra and then also to Covenant, right? So perhaps for Alan, like here in your case, you have a system where like debt should be priced by the market directly.
Yes.
And
yes.
Why is that important?
Well, I think at the end, all of these mechanisms, it can be complex or simple, but at the end of the day, it is going to be priced by the market. And if you have a system that is not priced by the market and it's a fixed price, the market will basically go to it if it's like underpriced, or will get away from it if it's overpriced. So at the end of the day, everything is market priced, I would argue.
Okay, fair point.
But I think one thing I find really important is we in crypto, I think we have to get better at communicating where the yield comes from. Because I think a lot of people in crypto, if they don't know, or at least in industry, if you don't know where the yield is coming from, you always feel the yield is coming from me that's giving you the capital. So how do we better show where that yield is coming from so that my risk amplitude drops, right?
Just explain in simple words, not using some terms like native internet money or whatsoever. It's like people don't get it. When you give them the analogy saying, hey, okay, you do trade stocks, right? They say, yeah, of course. And you do know what like a short long position is. Yeah, I know. And you know there is a funding rate. Yeah, that's how Athena makes money. But in crypto. They say, okay, that's clear, but what's native internet money? That's the problem, the words you use.
A quick hot take for this group, and I was talking with Matthias about this earlier. I have this hypothesis that on-chain risk-free rate, or the rate over US dollars, if you will, can be lower on-chain than off-chain, like actually lower because of the demand for stables. What do you guys think about that?
I think that like what we saw, if we look at the market, so for example, this IPOR index, it's based on what's happening on chain, right? So when we had the TradFi rates near zero, 2020, 2021, you were borrowing in DeFi, and you could earn 10, 15% per annum, right? So low interest rate environment in TradFi means we're in risk on. Yeah. And that means that people are actually taking a lot of risk in DeFi. They're levering up. They're using the money markets to actually get leverage on assets, right? So that means that you have this inverse correlation. And then what we had with the rate hikes, actually those rates dropped to sub 2%. And so you have this kind of strange inverse correlation, because you have the tightening of the monetary policy, and then you're going to get the basically the tightening of the risk taking in DeFi.
Could also be a different phase, right? That early on it was a leverage phase for crypto, and now it's more of a stable phase, maybe.
I think we're still in a leverage phase. Like one of the main uses of the DeFi credit markets is to leverage loop for yield-bearing stables.
Fair.
Also, there is, I think from all this year, there was a liquidity pressure in DeFi, maybe because of the technical risk, but liquidity providers still today are paid so much to provide on stablecoins. And so in an ideal world, then we create this great connection between CeFi, and this gets arbitraged way more. But pragmatically, as you mentioned, if we look at what are the rates in DeFi, they're extremely inflated, and because where the yield comes from, and usually the answer is the VCs from points, and then you get like people were not trading the funding rates through Ethena, they were trading the points, the value of the points of Ethena, then tokenized into principal tokens, but as collateral, doing some looping. That's what funds were getting, like hundreds of millions of buys of principal tokens at 40, 50% APY. So we're talking about like risk-free, and I think that this is improving a lot. Luckily, we're moving away from that, but also I think in all those years, we had so much hacks, and people were just asking for, the risk was not necessarily economical, it was just a security risk. And so that's what we had, a base rate on, we are not putting funds if we're not getting that amount of money, because we get hacks every day. So that was an important factor to take into account. But I think luckily we're moving to a more mature ecosystem, and now we are getting to rates that are closer to organical demand, lending rates, so borrow demand, and not just borrow to farm the new airdrop, but real demand.
I think one interesting insight could be when you look at the difference of rates for USDC and USDT. And right now, the USDC rates are higher, almost across all the protocols, and that's the point where there is more demand on the borrowing side from the companies, from the institutions that can only work with USDC. They can't work with USDT because they can't do the US on-ramp, off-ramp easily. So I think, and at the same time, in USDT, there is an abundance of supply because a lot of USDT is like more like degen crypto stuff, but they cannot lend this money to the companies, to the institutional. So I guess it could be something that we should look into where the demand goes and where it grows, actually.
I don't think that's right about USDC, USDT. USDC is the stablecoin of DeFi. USDT is a stablecoin of centralized exchange and also payments and remittances. So they have a fundamentally different user base. And we actually saw the USDT rate spike when people were trying to borrow USDT en masse to go into the Plasma pre-deposit campaign. But yeah, actually you have different rate dynamics between different stablecoins. And that's quite interesting because Delphi Digital, they put out a report. They were looking at the IPOR rates. So there's the IPOR USDC index, USDT, and DAI index. And in the time where Silicon Valley Bank collapsed and you had about 4% of Circle's deposits, we actually saw very interesting on-chain behavior where we had one very interesting player that was doing the contrarian, play where they sucked up all of the USDT liquidity available in the market because they could borrow it at 100% per annum to be able to actually sell at an 8-cent premium in USDT to a 8-cent depegged USDC and repay that basis
in a weekend. That was a very nice weekend trade. It was a very nice weekend trade.
But you have the rest of the market that's doing the opposite. So these on-chain data points, the idea of risk, and actually the different, basically the different plays in rates between different assets is quite fascinating. And I think I think there's also a lot of different stablecoins plays here, sitting on this panel. So different stablecoins with different risk and the collateral quality, and why is Circle so considered pristine versus Tether a bit more edgy? Because people are paying attention to what's happening on the balance sheet and the quality of the collateral.
Of course. But I would say I wouldn't fully agree with that USDT is not the stable coin for DeFi. There is a lot of USDT in DeFi, effectively, and probably not less than USDC still. But there is a lot of USDT on Tron, which is completely out of DeFi.
So, I mean, to me, the interesting thing is there's a big evolution taking place right now. And I think the risk, I think, is actually shifting from treasury bills, where that has been the benchmark, to the IPOR index, right? That's going to matter more. That's the hurdle rate in the future. Because governments can't sell their bonds anymore. Nobody's buying the government debt, which has traditionally been...
Except for Tether.
Except for Tether, maybe. But they're also now buying Bitcoin, right? So it's so you look at, what's going on. The US government couldn't sell its $19 billion 20-year bond. They had to go buy it themselves. They couldn't sell a 10-year bond, which was only $10 billion. So all of a sudden, the risk is shifting. These governments have huge amounts of debt. Now they're trying to say, hang on. If you own our debt, you can use that as collateral to mint stablecoins. So the same banks that actually fucked up the whole mortgage industry and generated the global financial crisis using mortgage rates as collateral are now using treasury bills as collateral to mint stablecoins and give you stablecoins. And so
you think it's bad?
I think that's fucking bad, yes. I think that's definitely bad. That's why we are in the crypto world. It's going to generate a lot of liquidity for us. So it's going to be short-term fucking brilliant for all of us in the crypto world. But it's only going to feed asset classes like Tether that has now got a football club. It's now got, Bitcoins. It's going to improve Nuon because we're backed by commodities. We're using tokenized oil, tokenized gold, tokenized silver that are asset-backed by commodities. We in the fiat world need commodities. And if you think about how did the dollar get dominance? It was originally all dollar-backed, gold-backed assets. And that gold is now gone. In 1970, they switched, and that created a huge amount of liquidity and instigated inflation. Right? That was the genesis of inflation. All of a sudden, there were other assets, maybe other things that came in, but in principle, money printer went burr. And that's what generated, astronomical turns and turn of event now.
But we're probably sitting here because of that event.
Yeah, no, we're definitely here.
Otherwise, we won't be here.
Exactly. And so we will see a huge new generation of opportunities in crypto, in the blockchain, because of what's going on right now. And we won't feel it in the next 2-3 years. Maybe in 4 years, 5 years' time, there'll be a drastic event that will drive a significant shift towards our assets. Sorry, I've been hogging the mic a lot.
But then the risk is also into just using dollar-denominated stablecoins and not just how you back it.
Yeah.
Right? Okay. Yeah.
I mean, if you think about banking in general, now treasuries are being brought in and tokenized in a way through deposits. But Tether Circle can actually invest in any sort of other, well, not anymore Circle, but Tether can invest in anything like football clubs or whatnot. The future is really bringing all of those assets on chain, to your point, tokenized commodities, but also tokenized loans. I mean, you might hate it, but tokenized mortgages as well. And
well, I mean,
whatnot.
does Tether invest from the reserves? I guess they use just their revenue to buy the football club, not like a collateral for USDT.
Yeah, I'm pretty sure it's collateral.
Where's the revenue coming from? It's coming from the revenue's coming from the collateral provided from the people minting Tether. And ultimately, it's coming from the yield from the bonds that they bought. It's coming from the appreciation in price from Bitcoin that they sit on. And now they're launching a treasury. So with that treasury, they're going to be buying more Bitcoin.
I guess they're also lending money. They have the lending structure.
It's a beautiful counter-cyclical model that's extremely simple, right? When you hike rates because you fuck up, you're like, okay, pay me. And then when you drop rates, they have the best risk-on asset that's ever been known. So
during the crisis, or the crypto crisis, when we crashed, they were redeeming, I think, what, $19 billion a day. I mean, what bank can do that? Right? I mean, I don't know any fiat institution that can do that. In Cyprus, they shut down the whole economy, right? They didn't allow people to, or was it Malta? I can't remember which country.
No, that's just because Tether's reserves, they don't invest them fully, right? So they keep it liquid because banks, essentially, they only have like a certain amount of reserves, so they cannot survive the bank run, while Tether is supposed to be able to pay out like 100% redemptions.
Which is great, right? I mean,
of course.
Well, maybe not.
Liquidity is super cool.
Maybe not at that redemption scale, but like literally DeFi has this mechanism where you don't have to ask anyone to withdraw. You know, the only thing that you have on a basic over-collateralized credit market is the utilization curve. And as someone starts to withdraw, it makes people repay their loans because the debt terms are high. And this is a beautiful mechanism. Okay. Yeah.
It's like topic-wise, we actually moved into this one, like which risks don't we yet see, which risks are not able to be captured. I've seen like a lot of things being developed recently where we can actually trade risks, which before you kind of have to accept it was hidden, right? This in this world, which risks now, like, but you can also go into like, which risks did you enable to be traded now, but which are you still missing before we get something even more stable or decently stable?
Not just one thing. So we create interest derivatives, right? And that's plugged on top of most frequently stablecoins yield opportunities. And so we talk to LPs, and basically they're interacting and trading and getting bonds on top of those opportunities. And one thing funny that I realized like the last years is they're less worried because most of those stablecoins had the same very much centralized mechanism. I think that's a risk that we don't see at the same time line, because like when it was a smart contract risk of a crazy algorithmic things, it was getting hacked, in 6 months. And when it's a fully centralized thing where there is a lot of money that is sitting in banks account and very centralized exchanges and that kind of stuff, then people don't realize it. But eventually, we're kind of growing the risk with the amount of liquidity that is there, and maybe one day, it will pop and we will see. I mean, basically, my point is this is not priced in because we're used to evaluate that something is safe because it's not hacked in 6 months. But the very much centralized thing, it can take a bit more than time to pop and break. And so I think that's not necessarily something that is priced in enough. and that's also because the risk that you're betting against is not just a hack. It can be a regulatory risk. It can be founders leaving. It can be things that takes a few years to appear sometime.
Yeah, I would agree with that. I think we started off with more sort of algorithmic / protocol risks. And now the more we start bringing real world assets on chain, we are getting more and more TradFi risks, which are sort of counterparty risk, operational risk from teams. Are they actually keeping those assets, the value of those assets, real world risks, and so on. So, yeah, it's expanding. I think the risks are expanding.
And that even goes back to what you were saying about the leveraging and the financial crisis in the US, right? We're actually replicating it in DeFi, also USD denominated, some asset-backed, some algorithmic, very little algorithmic. I'd like to see more algorithmic, but the reality is, it's going to be the asset-backed or deposit-backed. We're adding a lot of leverage to the system, and this is where things blow up. But it also means that more liquidity is coming into DeFi. When liquidity comes into DeFi, people tend to be able to eat it up and take leverage. You didn't have this happen after the collapse of FTX in this 2022, 2023 period, because you had, let's say, the credit facility was crushed. Ethereum price drops, Bitcoin price drops, so you have an actually oversupply of stablecoins, and that's just on this utilization curve. It's not being able to be eaten up. But as you bring RWAs on, and those are able to be leveraged against stablecoins, you actually increase the credit facilities. So we're able to, I mean, you were talking about what happens when this liquidity comes on. You'll see a lot more risk taking, you'll see a lot more utilization, you'll see a lot more activity, but you'll also see increasing risk that you mentioned for the financial crisis. So, there's a lot of risk and leverage that's entering the system, and this is also an inevitability.
So on that note, the risk, right? I mean, we went through the whole Luna, et cetera. That was particularly around algorithmic risk, right? I mean, that really hit the whole DeFi industry pretty hard. And do you think we've recovered from that? And do you think, as we're now shifting to more RWA risks coming on chain, when will we see the shift back to more innovation in the algorithmic era again?
Very soon.
Sure, but do you really think that was an algorithmic problem? I mean, the whole crash, I guess it was because the Collateral, this algorithmic Collateral was a vapor value and nothing else. So
I think, yes, a very interesting discussion, but we probably can talk too long about it.
Yeah, that's true.
And historically,
the question is, have we really seen a real algorithmic stable coin which failed algorithmically? That's
okay. Yeah. More perhaps philosophical. We definitely saw a very big one fail, which had a lot of algorithmic part in it. You already touched on another thing, which was we look a lot of economic risks here, but there are also a lot of operational risks. And in practice, we have seen actually operational risks taking a heavy toll historically. I'm moderating this panel as a security auditor, and generally am not the right person to ask questions about economic risk. But of course, I see the smart contract hacks, I see the key compromises, and I came from also a place of how banks do it, even if they act with crypto, which for them was just holding Bitcoin, right? Back in the days, the early banks, right? So 2016, 17. And they treated operational security really different than perhaps even the best ones do today here. Differently in the sense of very thorough. Do you see this risk, the operational risk? Is that priced in? Do we take it too not serious enough, basically, today? What are your impressions of this?
It scares me a lot. I mean, as a protocol founder, it's something that really is always in the head, because you can create the best security practices within the team, always having MPC wallet infrastructure, multi-signatures. But the problem is that we never know what we don't know, and we might not be aware of the risks that are there that we don't know. And for me right now, I think the best practice is to create the most permissionless framework and infrastructure as permissionless as possible, and as on-chain and non-dependent on the team as possible. That's probably the best risk mitigation strategy right now. So when you make the asset holders essentially being able to veto the whitelisting new assets or moving funds and stuff like that, that is like you creating an effective safety switch, which is in the hands of the people who are like the liquidity providers. And then, yeah, sovereignty comes with responsibility, but probably that's the only thing I can think of as ultimate security framework right now.
I think as a crypto industry, we are taking more operational risk than people realize. And I think part of it is it's hard to move fast and break things when you're talking about money. And so that's why banking is very slow, and we are growing fast. And so there's going to be a bit more risk than maybe some people would want, but we are getting better and better through audits, through other mechanisms to be safe.
And banks can erase or reverse risks by changing an Excel spreadsheet in entry.
Yes, exactly.
So this idea of having immutable contracts is an absolutely scary thing. Something you mentioned is that, and also related to this question is, from both an economic and technological standpoint, you should never accept a lower rate in DeFi than you get in TradFi. But that is not the case. It's not the case in practice. I mean, this is also like, but if you're talking about risk-adjusted returns, which is something you mentioned, risk-adjusted returns should factor in the potential for full loss of assets. That's implicit in the smart contract risk. So I don't think this is being priced in very well, but it's also the market that's pricing it in.
I have a side question. In TradFi, the risk-free rate is kind of like the same for the borrower and the lender. But in crypto, you're doing indexes. Is it the same, or you have two different rates for borrowers and lenders?
So the IPOR index, we started as just the mid-market rate between the market-weighted borrowing and lending on Aave and Compound V2s, and now it's on Aave and Compound V3s. And if we start to incorporate something like siloed Morpho and Euler pools, or for example, like Fluid, then you get a whole range of different rates. And how to synthesize those, it's actually a very difficult question. The risk contextualization. The first thing, actually, we talked with some guys that were doing different interbank offered rates. They were IPOR structures, and they're like, how do you quantify the risk of every collateral asset at the atomic level on Aave? And actually, the short answer is actually you can't at the smart contract level. You have to look at it in aggregate. You can't know at the atomic level how much is being borrowed against what asset. So DeFi has a different construction that you can't do it so granularly, but it's so the IPOR index is a very macro thing. It's implicit on a I wouldn't say rational, but maybe a more efficient market. But because we have such an expansion of innovation along the credit space, actually you get more liquidity fragmentation, you get more rate volatility. So the IPOR index, we'll also be launching some derivatives around the IBT of specific assets, because you need to be able to price an individual asset. Because I think the index, what we started is a very macro vision, but that won't be so useful until we get to an efficient market. So now we're starting to build derivatives around the specific IBTs, but that has more risk because you have higher volatility, you have market risk, liquidity risk, and everything around that. So yeah, it's we'll have different derivatives for the borrowing rate, the lending rate. They have different risk profiles.
So we touched on this topic also, like that the rates actually are driven by many factors, right? And then can be lower than what would be perceived as a risk-free rate. And sometimes it's higher. And then borrower and lenders sometimes are I mean, on one platform, it's kind of clear, but you look at it often from different platforms' perspectives. So what drives this in our industry that we see this kind of fracture across different protocols, different rates we see, and which sometimes seems to decouple from TradFi. What drives this?
These are the incentives. It's a norm in DeFi to pay for liquidity right now these days. So essentially, you're like many protocols pay for someone to bring liquidity to them. So that's something you don't see very often in TradFi when you kind of bring money to the bank and bank pays from its own reserves to make you keep that money there. So that's not usual. And regarding like this fragmentation of rates, so we've got so many blockchains and new chains that try to attract liquidity. And sometimes you see, okay, the Aave market, you're able to get USDT on Celo chain for like 1.5%. The problem is that as soon as you borrow it from there, the other side can pull off liquidity and your collateral is effectively locked there. And then the depth of that liquidity pool is so small. So you really need to be an expert to kind of be able to effectively utilize those things because these higher or lower rates, they can be deceptive. They are there only for the first like 100K and then it changes drastically. So you really need an expert or you need some analytical platforms to kind of navigate that. I guess that's, and incentives are the main reasons.
Yeah, very much agree on this. I think lack of arbitrage because DeFi has its economy of its own because of incentive point and many things, and the bridges are hard to build. And the reason why people are not necessarily arbitraging those rates is because exactly the risk is not necessarily factored in and hard to factor. So oh yeah, right, you get twice, 10 times the yield that you would have with a T-bill. But are you going to take that arbitrage? You're going to be locked for this amount of months. It's a protocol. It's a few people in the room. Do you really want to get exposed to this? And so that's why I think the risk factor is just too important at this stage for all this to be arbitrage. But I think we are seeing some actors that are taking those arbitrage opportunities on a few places, and they definitely are pushing the rates down because they know they have the liquidity and they have a better understanding of this. But there's a risk management issue and a lack of arbitrage.
Yeah, I would. So, like the IPOR protocol started with the assumption of an efficient market, and then over multiple years we realized that the market is not efficient at all. So we built Fusion, which is a market efficient engine to allow other parties to build on top of that to actually arbitrage these rates. But it's quite nuanced. You mentioned about liquidity. So the ape goes on DeFi Llama. They say number high. They put their assets there. Number drops. Say. You rugged me. Like, no, you don't know how to read on-chain data. You don't know how to read depth. But there's a lot of sophisticated actors that are actually starting to coordinate cross-market. Like, for example, like on Fusion, we have multiple people that are building multiple leverage loops. If you can have this asset here, this yield-bearing stablecoin on this siloed market, on Morpho, the PT instrument, the siloed market on Euler, the PT instrument on Aave, you have multiple liquidity loops that you can arbitrage or have your most effective allocation, but just people aren't sophisticated enough to do that, but you have more and more sophisticated actors. And as it grows in complexity, as it grows in different dynamics, actually, we used to track through the governance forums all of the governance decisions around the interest rate curves across all markets. And that was just, we realized it was just stupid. We couldn't do it. So we just fork. We fork the chain to understand exactly what the rate curve is at this time, do full simulations for asset allocation. And that level of sophistication is quite difficult. It's quite unique and nuanced to DeFi. But this will be the engine that powers asset management of the future in DeFi.
So I think taking a step back, you could argue the risk-free rate is the inflation rate of the US dollar, or should be that. And then anything up or below that, the US Treasuries is basically market forces, right? Like there's a war, people want US Treasuries, interest rates go down or risk rate go down. Crypto is like its own microeconomy more and more linked with TradFi, but it's still a microeconomy. And so we can have different rates versus TradFi depending on the supply and demand on crypto for either leverage or for stables. And that can go back and forth depending on what's happening on chain.
But I think we have that in crypto, right?
Yeah, we do.
We have different countries. Think of every layer one as a different country. Every layer one has different interest rates. You know, they have different inflation. All of them need security, by the way, just so.
Plug.
Because we're always changing. And I think the advantage and / disadvantage that we have in crypto is we're super transparent. So as soon as something goes wrong, everybody knows about it. Everybody learns about it, everybody adapts it, and the security guys audit it according to the learnings that have been shared. And that's done within a month, a week, a year, you know, depending, but it goes so fast that in the traditional world, they don't know about it because they're keeping it secret. They don't want to tell anybody about it. You know, they don't know, they're keeping it on their spreadsheets, you know, and they're adjusting it accordingly over time. But all of these changes are happening in real time. And I think right now, what I'm already thinking is, for our coin, you know, we at the moment guarantee our token holders yield of inflation. So we give you inflation adjustment, true inflation adjustment. And now I want the GPs to have IPOR adjustment. That's your hurdle rate at IPOR, because the IPOR is going to be a target that they need to beat in order to be able to reward. And the difference goes, so now, look, just on this panel, we've come up with a new idea, and now I want to implement it, and I need a security auditor.
Yeah, we are almost out of time. So towards the end, like, we have this thing currently going on with the Ethereum Foundation of about $1 trillion security. So going a little bit into the same thing, what does it take? And it's one of the questions from the security perspective we are looking at. What does it take that trillions moved to the chain, which basically is defined thousands of institutions are fine to store billions on it, or billions are fine to store $1,000, right? So both perspectives. But in this case, more from the institutional side of things, looking to 2030 or so, a few years out, not too long. And then we see the bond market, right, 130 trillion or so. And we see our very small industry today. What does it take? What's missing? Or where will it go in 4 years-ish from now? What is your, like, perhaps we do one quick round. Everyone does a little bit crystal balling. What's going to happen?
ETH at 100,000.
So number one, I don't think we're a small industry. We're $3 trillion already as an industry whole. Stablecoin is only 250 billion right now. And we think 2 trillion in 2 years. So this is going to go 10x in 2 years. I don't know, SG Forge, how many stablecoins do you already have in circulation within your closed environment? How much does JPM already trading in their closed environment? We don't even account for that. We don't even see that. That's not on-chain right now. If that were on-chain, we'd be very close to a much larger number than 250 billion.
Yeah, the stable coins would definitely grow like crazy. That's definitely going to happen. And so I think we're going to end up with 2 crypto worlds or 2 DeFi worlds. Like, one is like fully regulated with all those institutions, JP Morgan, BlackRock, whatsoever, having their permission blockchains and stuff, so that the bigger corps can interact with them and the entire US can interact. And then we'll have our old DeFi with a little bit of looping here, a little bit of over leveraging here, some degen trading and stuff. And I guess something's going to be happening like in the intersection of these 2 worlds, which is going to be cool. So the capital is going to be moving here from here and there. But I think like the upcoming years are really like fascinating. A lot of great things going to be happening.
Yeah, I share that very bullish view in terms of how big of an industry we're becoming. Institutional money is already here; it's just growing. But then it's it's not a one-night thing. It's an iterative process where you fix a little bit something. It's legal, it's risk management, and then you bring a little bit more capital, and then progressively the demand grows with what you can also offer. And Yeah, I think we're building the tools. You know, when we started Spectra, we discussed with people saying like, hey, we're doing this. You know, it exists in traditional finance, and people were, well, it's way too early, but it's going to exist sometime. It's going to be needed and used, and that's what happened even over the years. And like, build the tools that makes this ecosystem a safer and more modular and more profitable place as well. Like that's what we're all doing, and I think we're definitely in the right direction.
Yeah, if we see hundreds of trillions and an inevitability to come on chain, we have a lot of capital flowing in. We have a lot of different activities inside of DeFi. But one thing that, for example, IPOR Labs, we took a big risk on is that a lot of banks they're very well set up to manage their own internal risks, but blockchain risks are a different beast. So I would say that there's a lot of DeFi builders. There are very few good DeFi builders thinking about security, scalability. And most of the guys I've seen come in from TradFi, they build all the bells and whistles. Some of them get hacked as soon as they deploy on chain. So there's going to be a few different infrastructure stacks that are going to deploy a lot of this capital. And Fusion, we built actually for this to take care of the security, the modularity. There's a couple of very unique things on top of there. But also it should be the stack that TradFi is going to use as their entry to DeFi, because smart contract risk is quite a different beast. So we hope that maybe the efficient market goes through Fusion, that brings about the IPOR indices, and we have this $100 trillion interest rate derivative market inside of DeFi.
I think the only thing I would add, I agree with all of this, is something we were talking about earlier about operational risk. How do you bring the transparency that already exists in crypto in terms of like assets that are backing things, but can you bring that kind of transparency on the operational risk of the individuals bringing those assets on chain and deploying things?
Thanks a lot. Yeah, I enjoyed it a lot. Thanks a lot for the panel.
Thank
We're
you.
out of time.